I want to invite up our next panel. We heard a lot today about the three-legged stool of affordability, reliability, and sustainability. And it seems that the sustainability aspect, the environmental aspects of climate change and its impacts have been driving energy policy for the last decade or more. So I want to invite our next panel up, Pete Conway, Bob Kopp, and Jessica Weinkle, who will be speaking more on the climate change aspects and sea level rise, extreme weather, and risk. So if everyone could quiet down a little bit, we can begin our next panel presentation. As we mentioned earlier, everyone has their QR code, so you can see a much longer biography of each of our speakers if you use that QR code. But I'd just start by having our speakers give a very brief introduction as to who they are, what they do, and then we'll go more into their presentation. So we'll start with Bob, if you want to. So
you just want to do a quick intro?
Quick intro.
Okay. Hi, everyone. Bob Kopp. I am a climate scientist and professor of Earth and Planetary Sciences at Rutgers University. I'm also director of something called the Megalopolitan Coastal Transformation Hub, which I'll talk about briefly in my remarks. And I work on sea level rise, climate impacts, and a variety of other related topics.
Jessica?
Hi, all. My name is Jessica Weinkle. I'm an associate professor down at the University of North Carolina, Wilmington. I'm also a senior fellow with the Breakthrough Institute. I'm ultimately a policy analyst, policy scholar, study decision-making at the interface of science and policy, focusing on risk and largely climate. More recently, I've gotten into research ethics as well, and I'll talk a little bit about that later.
And Peter.
Good morning, everybody. My name is Pete Conway. I'm a managing director at a firm called Aon. If you're not familiar with Aon, we are one of the largest insurance brokers in the world, offering risk and insurance solutions to a vast array of clients across this country and around the globe. I don't like to admit this in public, but I will just for you. I've been in the insurance industry for just over 35 years, so feel sorry for me if you can. I've spent the entirety of my career on the brokerage side of the business, and the vast majority of that career representing clients that are owning, operating, developing, or investing in the energy, power, and renewable space, which we call Aon Natural Resources. Currently, my role, I head up the power and renewable practice for Aon in the Northeast. I'm the account executive leader for power and renewables in the United States. I also run our private equity and M&A practice for power renewables in the United States.
Thanks.
Thanks.
So let's get into our presentations. I'll turn it over to
Great.
Mr.
Thanks,
Kopp.
Ray, for inviting me. So I'm here, I think, wearing my hat as a sea level rise expert. Ray wanted me to set the scene on one of the major climate change impacts facing New Jersey. So that's what I'm going to do in my remarks and in the discussion. So first of all, I apologize if the fonts seem not to have made it through the transition. So if slides look weird or text is missing, I can clarify things later. So I promised I would talk a little bit about MOC. This is a consortium that I direct. It's a 13-institute consortium among the institutes shown here with 4 goals. So one is to further the frontier of scientific understanding, to better understand how human decisions at scales ranging from households to markets to policy interact with changing climate risk to shape how well we can adapt to those risks. And the second is to push forward the scientific, to take that knowledge and use it to facilitate flexible, equitable, and robust long-term planning to manage climate risk in our region. So we're focused on the Philadelphia, New Jersey, New York City region, while at the same time training the next generation of researchers and engagement specialists to do those things, and learning how to build better partnerships between academic institutions and stakeholders. And we would love to talk to any of you who want to further engage with us on that. So let's set the scene on sea level rise. Despite what some people hired by the Department of Energy, or I think Jessica's going to talk about in a minute, may claim, we know quite a bit about what's going on with sea level rise. We know that global mean sea level rise has been rising at an accelerating rate since about 1970, and that over the last century, it's risen more than in any century in at least 4,000 years. Our group at Rutgers is actually one of the pioneers in this work on using the geological record and statistics to reconstruct past sea level change. So we've gone from about half an inch per decade over 1900 to 1970 to about 0.7 of an inch per decade over 1971 to 2006 to about 1.5 inches per decade over the last 20 years. So that's global average sea level rise. We are here in New Jersey, and sea level rise doesn't rise at the same rate everywhere for a variety of factors, including both natural geological processes, like the sinking of the land, and changes in the climate. So this plot's another one that came out of our work at Rutgers. It was produced by Jennifer Walker, who's now on the faculty at Rowan University. And what we're showing here, the gray bar, that's that long-term geological rate of sea level rise. The red bars are the global rise rate. And so what we see from this study is that we went from about 0.5 inch per decade of natural sea level rise over the period from 0 to 1700 CE to about 1.3 inches per decade in the last 6 decades of the 20th century. So we went from a time where basically 90% of sea level rise in our region was the natural sinking of the land, the result of the fact that there used to be a giant ice sheet in northern Jersey and further north, to, in the late 20th century, about half of sea level rise being driven by climate change. And that fraction has continued to increase in the 21st century. So in fact, if we look at the observations of sea level, here we tend to use Atlantic City has the longest running tidal record in New Jersey, going back to about 1920. But if we look forward since 2000, we've had about 2.3 inches per decade of sea level rise. So we've gone from 0.5 inch to 1.3 inch to 2.3 inch. So sea level is accelerating both globally and in our region. And we've experienced the impacts of this. This is not an inconsequential amount of sea level rise. We've gone from about 2 days per year of high tide flooding along the Jersey Shore. This is figures for Atlantic City in the 1970s, to more than 10 days per year in the 2010s. And this is a photo taken by Rob Almueller, who is the spouse of the executive director of MOC, who took this picture during the nor'easter that happened a couple of weeks ago out in Tuckerton Beach. And one of the things you can see here, the wheels of the car are about half covered with water. Well, if we hadn't had sea level rise over the last 5 decades, that car probably wouldn't have had water on its tires. So that's the difference that this extra amount of flooding from sea level rise makes. So our colleagues at Rhodium Group, which is energy, environment, and emerging trends consultancy, did a study a few years ago looking at what's been exposed to property that's been exposed to flooding in New Jersey as a result of sea level rise. And this study found that as of 2020, about 23,000 more New Jersey properties were being frequently flooded than would have been if sea level had stayed at its 1980 level. And that was worth about $13 billion worth of property, right? So these are real impacts with real costs. So for the next few slides, I want to talk about what we're facing in the future. And I'm going to draw upon the work of the Intergovernmental Panel on Climate Change's 6th assessment report. Together with our colleagues in the Netherlands, I helped lead the synthesis of the sea level rise projections in this report, which came out in 2021. And this map here is from a tool, the NASA IPCC sea level projection tool, where you can go in and look at anywhere in the world and see what the IPCC assessment has to say about sea level rise projections for that region. And what you see is a few things. First, through the middle of the century, through about 2050, given the sluggishness with which ice sheets and oceans respond to warming temperatures and the sluggishness with which we can plausibly change our energy system, sea level rise is largely baked in. If we're again taking Atlantic City as indicative of sea level rise in New Jersey, if we look at the period from around 2005 to 2050, we're likely looking at about 1 to 1.7 feet of sea level rise, regardless of whether we're in a world of sustained emissions growth or one in which emissions are brought down sharply, consistent with international climate goals. But beyond 2050, the trajectories of sea level rise start to diverge in response to emissions. So if we're in that high emissions trajectory of sustained growth, that would get you likely, meaning about a 2 in 3 chance, to about 3 to 4 feet of sea level rise in New Jersey by the end of the century. In a world of sharply reduced emissions, much more like 2 to 3 feet. And that difference grows substantially as you look beyond 2100. What's more, we also know that those projections don't factor in cutting-edge science about how ice sheets interact with the climate, because we don't understand that, right? As a scientist, I get really excited about the stuff we don't understand. But as somebody concerned about supporting decisions, it's unfortunate that most of the stuff we don't understand either will have little effect or make things worse. But that's the way it is with the polar ice sheets, right? Maybe it's not going to be a big factor, but it might be. And so we have to think about it. So there's a bunch of things that the IPCC flagged as potentially causing sea level rise above those ranges by the end of the century. They have to do with modes of instability in the ice sheet in Antarctica and potentially with faster than projected melt in Greenland. Based on work my group has done since the IPCC assessment report, if we're on a sort of that high emissions trajectory I was talked about, that could push the range of sea level rise significantly above 5 feet by the end of the century in New Jersey, and again, much more beyond that as you look beyond. Another way of thinking about that is that sea level rise is baked in, and what's not baked in is how fast we're gonna get there. Think of this plot on the left, that's a timeline under 5 different emission scenarios of when we get to 2 feet of sea level rise. So if we're under a high emission scenario, it's pretty likely we will hit 2 feet by about 2060 to 2080. If we're under that low emissions trajectory consistent with international climate goals, maybe you still get to it by around 2060, but maybe it takes until around 2110. So that's 2 feet. 4 feet, we're still gonna get there, but again, it's even more uncertain about when. If we're under a high emission scenario, that's likely between about 2095 and 2145. If we bring our emissions down, that could push that back to 2120, or maybe even as far as 2260. But again, there is a substantial uncertainty regarding these rapid ice sheet loss processes that are really interesting as scientists, but are deep unknowns when we think about policy. And that potentially could move that date for 4 feet as early as 2080. So even if we put aside those big numbers, modest sea level rise scenarios, this one is one that just gets us to 1.2 feet by 2050, have substantial impacts. So based on NOAA analysis, just with its low-end sea level rise scenarios, parts of the Jersey Shore are looking at least 50 days flooding per year on an annual basis by the late 2030s, and about a 50% chance of one day with at least 50 days of tidal flooding per year by around 2030. And these risks are not baked into our property market. Work done by our mock colleagues at the time, we're at the University of Pennsylvania. Now Carolyn Kuski and Jesse Gorovitz, they moved to EDF and Insurance for Good. But they found that as of 2021, New Jersey property values did not capitalize about $8 billion worth of current and near future flood risk. And that nationally, flood risk is undercapitalized by somewhere between about $120 and $240 billion. And this creates the risk of a future crash if that uncapitalized value risk isn't slowly lit into property markets. And this map here is showing you where that undercapitalization is distributed in our region. So one way of adjusting for that is to invest in adaptation. So that can be, this is a figure from the IPCC, that can be things like beach replenishment, which is relatively rapid but has a short duration for which it's good. It can be things like elevating houses, which is a little slower but lasts a little longer. It can be things like building protective infrastructure like levees and seawalls, even slower, even longer benefit, or it can be things like moving out of regions that are high risk, quite slow, but also the only thing that has the enduring protective value. On top of that, we also need to think about the role of insurance, both public insurance and private insurance, as long as there is still private insurance for these risks, and how to gradually let real estate markets learn about this flood risk information so that markets can do the marvelous things they do in terms of helping make good societal decisions when they're given the right information. Thanks.
Thank you, Bob. I'm on. Okay, thanks, Bob. Jessica? Yeah, absolutely.
Hello. All right. Hi, guys. So my phone's all messed up too. So hopefully, yeah, it'll be okay. So the inspiration for the title of this talk comes from my students this year. And it's been a growing thing over the years, but it's been pretty obvious this year, where the questions are not climate change, yes, no, climate change, what are the risks? They're pretty comfortable with the idea that anthropogenic influence on the climate is real, fossil fuels are a leading factor, there are risks associated with it, they're good with that. What they want to know now is, why is it so loud? Why is it so constant, so extreme, to the point of being somewhat comical? So a lot of my classes now are just trying to explain the larger ecosystem of interests and researchers and institutions that come together that create a very large climate change spectacle. So climate change is real, important, fossil fuels and all that, but the loudness of it has taken on a whole other different thing. So I'm going to start here, actually. There was a report at the end of September in Politico. It was a very fancy, one of these like interactive news reporting sorts of things, about the Department of Energy report that came out over the summer on greenhouse gases' influence on the climate. There's all sorts of discussion that you can have about the report and subsequent events. But I just wanted to point out what they had picked on in this story. So it was a longer story about the report and the people that wrote the report, but then they honed in on this one issue. They said that the authors of the report, they stated this one sentence about hurricanes out of the IPCC report, which I had plans on reading to you, but I can't see that far. So, but this idea that there's low confidence in long-term trends because of technological change. And so one example of what that looks like is this. So the image on the left is an early satellite image, one of either the first or one of the first detections of a hurricane by satellite. And the one on the right is a recent, this summer, image of a hurricane. The dramatic difference in the granularity, the ability to see what's going on, the just general observational capabilities are tremendous, and that's been a huge human accomplishment over the decades. But it's also led to a difficulty in saying that what we see as far as trends in recent history is somewhat different from what we've seen in the past, because we don't have the granularity of that data in the past for many things, maybe not all things, but many of them, particularly hurricanes. So the political authors are upset that the second sentence wasn't stated. And the second sentence, to me, is basically absence of evidence is not evidence of absence, which is all well and good. But to the extent that you can't say for sure whether or not what you see is anthropogenically induced or a result of variability over time, does not make it so that you can say it. Just because you can't say it doesn't mean that you can say it. So the challenge in this is what's happening is it's not coming out in the media, right? So this, the nuance and the level of the limits of scientific knowledge, of empirical information, is not what we see constantly in the media. You know that, I know that, the students know that. So on the left is just standard fare media stuff, which takes every sort of every hurricane, every extreme event, and labels climate change on top of it, and say this is it. This is what's happening. On the right is more of a real life assessment of what's happening, where you're looking at our loss experience. So whatever may be happening in at least hurricanes in those events is not showing up readily in the loss experience. When you look at leading factors of losses, damage basically, it's the way that we construct our communities, our growing urbanization. When there are efforts to put some semblance, some label of climate change onto it, usually it's been 1%. I've seen 1% be labeled also a high estimate. It's largely a guesstimate where the virtue signal is, there's climate change in there, I'm sure of it. And that's fine. But the point to be taken away out of it is it's not the leading factor in the losses. It's not the leading factor in our experience. But that's not what we're seeing in the events, or that's not what we're seeing in the media. So what can we do about limiting uncertainty? So I'm going to focus on the right for the sake of time here. But there's two scenarios, emission scenarios, if you will, that are the leading, they're the leading scenarios used for projecting high-end climate change. This is SSP3 7.0 and SSP5 8.5. If you look at the blue dot, that comes from the International Energy Agency and their estimate of coal use by 2050. But if you look at the lines coming from the other two scenarios that are used by the IPCC, you see a very dramatic deviation from that. The International Energy Agency is an energy energy analysis and recommendation hub under OECD, I think. Whereas the IPCC is a climate change intergovernmental panel. But in any case, the orange line depicts a renaissance of coal, where mid-century we're going to cap out on our use of oil and gas and move towards coal. We're going to have very high GDP, and that's all going to be fueled by coal use. We're going to start liquefying coal for transportation, and that is going to drive very high emissions by 2100. The SSP3, the green line, sees regular increases in coal use, not as dramatic as the SSP5, but it also sees about, I want to say like 12 billion, over 12 billion people by 2100, which is about 2 billion or so over what we have in UN projections by 2100. And if you're aware of rather strong discussion right now about reproduction rates basically all over the world, so not only do you have very questionable assumptions about coal use moving forward in that scenario, but you have extremely implausible, if not known to be false assumptions at this point about population growth. So this is significant because this is driving a lot of views on climate change, future climate change projections, and they are everywhere, everywhere. They're in research, they're in business, risk analytics, they're in advocacy, they are in central banking practices, mainly in Europe. And it's it's a concern. Anyways, given the extent that climate change science has become so significant, climate change science was always significant for politics. It's become very significant for finance lately. Well, over the last, I don't know, 10, 15 years. It's always been significant for reinsurance since Andrew. But it's fostered a relationship between climate change scientists and advocacy groups and business industry, financial industry. That has been not well described more broadly. Traditionally, we've been very concerned about conflicts of interest between researchers and fossil fuel industry. Researchers, in the past, we were concerned about researchers and their relationships to nuclear, chemical companies. I would say that there's also a concern about what else people are doing, their consultancies, their board memberships, their directorships. What are their interests in specific views of climate change? Anyways, so I'm going to close, actually. I had this very busy slide that I was going to close with, but I'm going to close with two different ideas right now. I was inspired by a New York Times article that I was reading late last night. So currently, Jamaica is struggling right now with a pretty devastating hurricane coming forward. And there was an article in the New York Times that last night that the narrative made it sound like the hurricane and Jamaica's experience of this hurricane is a climate change issue. Without fair consideration, first of all, it jumps the gun, right? Because it sort of declares this scientific, outlook that it's because of climate change that Jamaica's having this problem. But it falls into a larger idea, I think, of what a philosopher in Canada has called, highbrow misinformation. And it's these narratives that are coming out, they're misleading narratives coming out of our most educated professional organizations, our universities, our NGOs, our journalistic organizations. They're misleading and they're losing sight of what we empirically know, and spinning these other stories that are very difficult to pull away from because they reinforce the same biases within these institutions in which we're all educated in. So this is an actually significant problem for creating a sort of big tent politics that can create a stable energy policy future, that can create a stable economic future, infrastructure future. And the second idea that I'll leave you with is that your resiliency politics does not have to be entwined with your energy politics. I would say that my impression is that Florida's done a fairly good job with this, where they're looking for infrastructure and resilience that moves into the future for prosperity, and that is not tied to visions of an energy future and what that might look like. Anyways, thank you.
Thank you, Jessica. So we heard that sea level rise is a real and growing concern. We heard that extreme weather is happening and may or may not be related to climate change. So how does an insurance company deal with those types of risks? Oh, you absolutely can.
Kicking right off the stage. I'm sorry about that, but it's better standing. Well, when I'm lucky enough to speak at conferences like this, oftentimes what I'm asked to do is talk about macroeconomic trends and specifically risk trends and how they affect my client base. Client base operating in various sectors of the energy, power, and renewable industries in particular. And these macroeconomic trends are the same trends that you see in the paper. We've already heard a number of them in previous presentations, and you're going to hear about them throughout the course of these next 2 days. So I won't delve into that because there are people far smarter and far more able to do so. But what I will concentrate on is how the insurance industry looks at natural catastrophe risk. And I want to do that for two reasons. One, I'm hoping it's a nice complement to the presentations we've already heard from my co-panelists. And two, natural catastrophe risk and how insurers look at that is a sneaky, deceptive, really critical piece to the overwhelming, in my opinion, macro trend that's affecting certainly the power and the renewable sector in New Jersey, in PJM, and across the country, which is load surge, demand surge, the need for more power. The need for more power means refurbishing existing grid infrastructure. It means building new. And whether you're talking about building new in solar or wind or battery energy storage, right, renewables, nuclear, combined cycle, gas technologies, making coal cleaner. However you are looking to increase power sources to address this grid demand, that takes us to the traditional side of the insurance industry, which is the old school property and casualty. And property and casualty insurance is driven unequivocally by natural catastrophe risk. When I say natural catastrophe risk, what do I mean? Well, I used to call them the 4 horsemen of the apocalypse. Now I think there's 5. But earthquake, flood, named windstorm. You just referenced Hurricane Melissa, which is about to go through Jamaica and the Caribbean, unfortunately. Wildfire, right? And the 5th one is severe convective storm. If that's not a familiar term for you from an insurance perspective, that's hail, lightning, tornado, that sort of risk. These perils have the ability to introduce severity to insurance companies, and they also have the ability to introduce losses to multiple insureds, multiple policies at the same time in a short period of time. So therefore, unlike traditional insurance, which is on a per occurrence basis, I won't go into this too far, I promise you, most aggregated natural catastrophe perils, most natural catastrophe perils are aggregated, which means they are limited in the amount of insurance you can buy to protect insurance companies from that aggregate risk. That is why natural catastrophe perils drive supply versus demand in commercial insurance, which drives pricing, which drives viability of projects that are being built in this state and others, which drives lender contractual requirements that affect the ability for projects to be viable. And that's why I'm going to concentrate on this in the time we have here. How do insurance industry look at risk? Well, 2024, it's a year above average, I say, right? And there's a lot of, did that switch? Hold on. There we go. I can work a clicker. I'm good at this. 2024, right? So that's a year above average. And there's a lot of numbers on this screen. But if you look at the left-hand column, that's telling us there was approximately $368 billion worth of economic loss in the world in 2024 attributed to natural catastrophe risk. That is above average. The number of billion-dollar events at 54 is above average. And then the next column, one over, is the insured losses, right? And that $145 billion estimate is well above average. And the number of billion-dollar insured events at 34 is also well above average. The 60% you see in the bottom left, right? That is the global protection gap. And what that is meant to represent is the difference between economic losses that were sustained due to catastrophes, and insured losses, those where risk was transferred to the commercial insurance market. As you look at this, 2024, two numbers pop out to me. 78% of all natural catastrophe risks took place in the United States, and $61 billion of catastrophic loss is attributed to severe convective storm. Why do you think that is? Renewables, solar, hail, right? More on 2024, a continuing trend. You can see the graph on the left is showing that, generally speaking, billion-dollar loss events, economic or insured, are rising over the course of time this century. In 2024 itself, the main culprits for losses were U.S. hurricanes and severe convective storm, also in the United States, as well as floods in EMEA. All right? A graphical representation of the same shows those severe convective storm events, those hurricane events, and those flood events. What do we notice about where those circles are? No disrespect to any other continent or part of the world, but those losses are occurring in heavily populated, industrialized areas, which affects that global protection gap, right? The difference between economic losses and insured losses. Okay, so what about now? We're 3/4 of the way through 2025. How are we doing? Right? Well, it depends on who you ask. It was a pretty, from an economic perspective, economic losses were actually ahead of the curve. It's actually been a really good year for economic losses, particularly the third quarter was very, very quiet, knock on wood. But insured losses are actually above average, so they're following trend. That $114 billion worth of insured losses is above average, and the number of billion-dollar losses at 22 is also above average. The Palisades fire, remember that? That seems like a long time ago. It wasn't. It was this year. Those wildfires in California, and again, continued SCS, severe convective storm losses, are driving this. And look at those U.S. numbers. 88% of the losses that we're recording in the insurance industry are in the United States, which lowers that global protection gap to 44%, because these losses are occurring where insurance is more likely to take into effect. So how we're doing in 2025 also depends on where you are, right? So if you're in the United States, which most of us are, if we're operating, owning, developing, investing in infrastructure assets in the United States, this is a bad year for us. More graphs, and I won't go into this, but if you look at that bottom graph, those are the 4 geographic sectors of the globe, and you can see the United States at the right is dominating all those losses. So what does that mean, right? Climate change, right? More events, more frequency, potentially more severity, and they're happening in places where more people are, more exposure. Couple that with economic factors, inflation, tariff risks, supply chain issues. Those are increasing costs. And what does that result in? Bigger losses, which result in rising premiums, generally speaking, in the insurance industry. I won't go into all of this, but when you think, I will not at all, I'm going to summarize this. When insurance companies think about risk, in the top left quadrant here, we're looking at property-driven risk. And what they're worried about is those aggregated perils for all the reasons we've just discussed: severe convective storm, wildfire, and also regional concentration, right? If I had $1 for every developer said that they were going to build a solar farm in West Texas, I would have retired by now. People are putting new assets in condensed places, which are exposing them to catastrophic perils. On the liability side, one of the big drivers is social inflation. Right, the large number of nuclear verdicts, high verdicts are driving liability insurance premiums higher, as is infrastructure conversion. What that means is electrified assets are putting closer and closer to population centers, rooftop solar, warehouse BESS inside. Lines coming closer and closer to populated areas are increasing liability. The cyber threat is a huge liability issue for the entire industry. If you want to really make everybody in this room cranky, let's turn off our phones for a couple of days, see how we do. I can't imagine. And wildfires again, right? Technological and operational risks, I won't go into, right? But with this, these are technical assets, and they face technical issues. So the insurance industry is always looking to underwrite. There was a time when BESS, battery energy storage, was a no-touch. Oh my gosh, we can't do that. Now it's looked at a very safe risk. As long as the spacing is right, there's always emerging technologies. Floating wind, floating solar, right? Small nuclear reactors, hydrogen. These are all things that the insurance company is going to adapt to. And then market trends is transition risk. To me, of all these things in market dynamics, the biggest one is transition risk. Yes, it is important that we focus on renewable energy and green energy as a sustainable way forward. No, it is not reasonable to forego the other asset classes as we have this demand surge. So making sure that the insurance industry is balanced. There's insurance for coal, there's insurance for combined cycle, there's insurance for all elements of renewables is really important. And last but not least, it's just one piece of the puzzle. So highlighted in red are 4 of the 5, horsemen of the apocalypse. All these other boxes, were discussed in part and whole by my co-panelists. And generally speaking, the insurance industry concentrates on this heavy lift so you guys can build, but some of the things that are the trends that I'm not going to talk about were what we used to call business risk or speculative risk. They were uninsurable when I first started in this industry. And now they all are. Hedging products, pricing projects, tax liability to make sure those tax credits are there when you need them. All these things were not insurable when I started, and they're insurable every day now. So I'm very bullish on how the insurance market's going to react to this challenge and all going forward.
Thanks, Peter. A wide range of perspectives. We have time for a couple questions, and let me start with you, Bob. You had mentioned the certainty of sea level rise, but within that, you had a wide range of projections as to what may or may not happen. How do policymakers, how do insurance companies like Peter measure in that risk given so much uncertainty?
Yeah, so I think we should think insurance sort of comes in 2 ways, right? One is what the insurance companies actually do, right? They insure against short-term risks, typically year-to-year contracts, sometimes reinsure slightly longer. And within that context, one thing we should just acknowledge is that risk has increased. Jessica focused on the sort of uncertainty in characterizing what's happened with hurricane winds, but sea level rise has definitely happened. There is a human contribution, and about 10% of the damage in Hurricane Sandy wouldn't have happened without that human-caused sea level rise. So just to be clear on that. But most of what I'm focusing on is how we take things that we can, in this context, learn from insurance markets. So things like parametric insurance, insurance that is not tied to having to necessarily do a damage evaluation, but to a trigger in terms of a natural catastrophe. I think we can learn from that and how we think about longer-term adaptation planning. So, right, we will hit 4 feet of sea level rise. We might do it by the end of the century. It might be later. So how do we think about telling markets that, okay, this is an area that might be safe to build in, but when we hit 4 feet of sea level rise, it's no longer safe. So how can we develop policy instruments that sort of built in the idea of parametric retirement, right? You've got several good decades in this area, and maybe you'll have a good century. But we don't want people to buy a property that, at its best, it's going to be offloading the costs on society to deal with reconstruction costs when we can say this is going to be at risk. So how do I think we need to be thinking about policy instruments that build in the idea of certain areas being okay to build in for a time. That time may be multiple decades, but that we bake in now the idea that, at a certain point you have to give this back to the ocean, which is coming for it anyways. And right now, most of our policy is focused around things like picking a single number and building in a single safety margin. And that works great if we're looking out a couple of decades, but when we're looking out to 4, 6 feet of sea level rise, we have to think more about how do we use policy instruments that deal with the uncertainty we have, while also recognizing the certainties we have. Thanks.
Let me turn to you, Jessica. You had mentioned that the press is out there with headlines every day, the current hurricane out there, and attributing it all to climate change. You took a little bit different viewpoint, and I think the IPCC and AR6 also took a much more conservative viewpoint as to how it looks at climate change's influence or certainty on extreme events. There's a new, I'll use the term, science discipline of attribution science that's coming out. How's that different from the model we currently use, and why does it matter? If you want the podium, you can come back up.
Okay. So it matters for a couple of reasons. So classically, there was the detection and attribution framework where you would look at the data collectively and you would say, is there a change from the past, right? So is there a statistical difference? Then you would try to figure out how to explain that difference. The detection and attribution, what I think you're referring to is extreme event attribution, is taking singular events and saying, okay, how has basically the probability of distribution changed, either in frequency or magnitude, today in a warmed word versus a modeled counterfactual, which is a totally different way of looking at detection and attribution and climate in itself. So the reason it matters has become, because there's two reasons in my opinion. One is fairly well known. It's very tightly bound to litigation efforts, developed specifically in pursuit of advocacy about the connection of extreme weather to anthropogenic climate change, and then using that as a methodology to support litigation claims against fossil fuel industry for liability for damages. So that's why it matters legally in that context. Another reason that it matters is, and this relates to the COI piece I was talking about earlier, is that the way that methodology is constructed leaves a lot open for decision-making as you go along and do it. And so to the extent that it has been very clear that the people practicing it, many of them are pursuing litigation or trying to support that bias is potentially coming out through the methodologies and the choices that they're making as they implement their studies. And the other piece is that there is a fairly significant effort, and you can see it in the media, to connect extreme weather and the anthropogenic influence on the climate and damages, all three of those, in an effort to support public acceptance of attribution studies. And then ultimately sort of the court of public opinion as to how people will weigh in and see the appropriateness of climate litigation and things like the Superfund laws. I'm sorry, the climate Superfund laws, yeah. So it's a complex, interesting. I'm fascinated by it, but it's complicated.
Thanks. And let me, so, Peter, you've heard everyone here today, and you talk. We keep hearing that the insurance markets are drying up, especially in areas subject to these extreme weather events, sea level rise, et cetera. But yet we know that the insurance markets are also cyclical. So where do we stand right now in the insurance market? Is it changing? And how does that impact rates?
That's a great question, and thank you. So one of the tricky things about commercial insurance is that major product lines are in different cycles, right? So we call hard market and soft market. Soft market is good for most of the people in this room, and assuming there's no insurers in this room, where it's easier to buy insurance, supply exceeds demand, and a hard market is where it's harder to buy insurance and capacity is not available at any price. Right now, the property market is in a very favorable spot, and that is after 5 years of intense hardening, particularly in the renewable energy sector. From an insurance perspective and a property insurance perspective, for decades, the renewable energy insurance risk was in the hands of 3 or 4 insurance companies, and they competed like hell for that business, which drove deductibles down very, very low, limits very, very high, no limitations for natural catastrophe risk, and they sustained horrific losses. And eventually, around 2019, that market fell apart, right? And rates skyrocketed, and coverage dropped. Everybody went out of compliance in their loan covenants, and we started thinking much more carefully about where we put our dollars and cents as insurance companies based on geography, as my friend to my left here was just talking about. So right now, the market has just completed, the property market, a correction where those 4 or so renewable energy insurers have now, they've stayed in the industry, but they've been joined by traditional European insurers and insurers in the United States that write more traditional power and energy risks. They've right-sized the industry for the long term, and now supply greatly exceeds demand. So it is, believe it or not, a much better time to buy property insurance in the marketplace, and then you make decisions on how much natural catastrophe insurance you buy with that additional savings and where. Casualty market, softening also, but still hard. Autos driving a lot of that, and umbrella costs for the reasons we talked about. The casualty market is still ahead of the property market, but both are generally trending favorably, and certainly more favorably than they were at the beginning of this decade.
Thank you. We have time for one more question, which I'm going to ask each of you to respond to. If you keep your answers succinct, we're running out of time. I greatly appreciate it. This is an energy conference, and we heard today about our growing demands from AI and everything else, our lack of supply. If it were easy to convert fossil fuel-based economy to a renewable economy, we would have done so already. Some argue maybe we could do a lot more. But how would you advise? There is obviously benefits to fossil fuels. As we go through our transition, what policy advice would you give policymakers? And we'll go this way, Peter.
Yeah, I think a common sense approach. Right, so the insurance industry tries to be agnostic. Over the course of my career, I've represented clients operating in every side of the spectrum, right? From the dirtiest of the dirty to the cleanest of the clean. So I think a common sense approach in power-based infrastructure is really important right now. That's what I was talking about earlier with transition risk. Making sure that the insurance industry, in my perspective, supports balanced growth with a focus on renewables, undoubtedly, right, as our future, but making sure that traditional energy is there to support that renewable growth until at such a time where it can sustain itself.
Thank you. Bob?
Yeah. So I would say that climate change is causing measurable harms, not necessarily relying on all of the models that Jessica talked about, but just from basic thermodynamics, we know in a warmer world, we're having more intense heat waves, more intense rainstorms, more intense evaporation leading to more drought and more wildfire conditions, and higher sea level rise leading to more coastal floodings. Those are costs. Right now, if those costs are not priced right, they're being externalized, meaning they're paid by everybody except the people who are emitting carbon dioxide. We need to look at policies to internalize those costs within the constraints of what's politically feasible. I spend a lot of time working with economists. I would love an economy-wide carbon price that reflected the social cost of carbon. That's not politically feasible. We've been tried. That doesn't work. And the solution is not to say, oh, well, either we have the economically first best policy or it's great to externalize all those costs. We need policies that are achievable, that manage bringing emissions down consistent with the social costs they're inflicting, and that may not be the first best economic policy. It's something that happens within political constraints.
Thank you. And Jessica, advice for policymakers. You have the last word.
Okay. What Pete was saying definitely resonates with me with a reasonable approach. I don't know that I'm the best person to say, here's your suite of, this is what you should do policy-wise for energy. But I think that a concern, and what I've heard in our introductory remarks earlier this morning, was that we cannot fall behind, right? So the political cost, the socioeconomic cost to the nation if we fall behind on infrastructure and energy is well beyond the cost of what we're seeing in what is the current projection of plausible climate change in the future. Which doesn't mean it's not a concern. It doesn't mean that we should not invest in our infrastructure and our resiliency and decarbonize our economy. Those are all good things that we should work for. But the security of the nation is a must. It's not something that we can sacrifice.
Thank you. I'd like to thank our panelists.